Right, so lately I've been making a lot of videos on ETFs, and ETFs are great and all, but I've been meaning to make a video on stocks. And that's when the powers that be brought me across this article titled 11 Best Dividend Stocks to Buy According to Warren Buffett. We're going to go ahead and evaluate each of these stocks to see if they're a good buy at the current moment, as well as showing you guys my research process. So if you like the video and enjoy, as always, give the video a like, subscribe to the channel. It helps me out a lot and it's greatly appreciated. And right here is the methodology. So it says, let's analyze our list of the best dividend stocks to buy according to Warren Buffett. We chose the stocks with the highest dividend yield in Berkshire Hathaway's 13F portfolio as of Q2 2021. And as mentioned, we're not going to go over all 11 names, just the top 5, beginning with Kraft Heinz Company. So this company is an American food company that holds over 200 iconic brands. The company stands 5th on our list of best dividend stocks to buy, according to Warren Buffett. In Q2 2021, Berkshire Hathaway did not make changes to its position in the Kraft Heinz Company. The hedge fund holds over 325 million shares in the company with a total value of over $13.2 billion. The company accounts for 4.53% of the fund's 13F portfolio. Alright, so taking a direct look into this company, the first place I always go is Seeking Alpha, simply because I like the website and they have a good mixture of most of the information that you're going to need to make an educated investment. So let's begin with valuation. We can see in the past 12 months that the stock is up 19%, although it is coming off of a recent high. And if we zoom out to the past 5 years, the stock is actually down 53%, leaving it a PE ratio of only 13.4. So in terms of valuation, on the surface, this is pretty cheap right now. But to see if that valuation is a discount or if it's justified, we have to look at the financial performance of the company. And to me, the number one metric here is the total revenue of the company. This is a great way to see at a glance if a company is growing, shrinking, or being stagnant. And when it comes to this company, their total revenues are kind of flat. Another metric I like to look at is cash and equivalents on hand, and in December 2020 they had $3.4 billion, and a nice comparison you can do with that number is compare it to versus the long-term debt. And when it comes to the debt of this company, it's relatively substantial at $28 billion, although luckily the debt isn't increasing, and if anything, they're paying it off slightly. In fact, if we look at the cash flow from financing activities, we can see a breakdown of the total debt issued as well as total debt repaid. So the company is issuing new debt, but they're also paying it off at a slightly higher and more aggressive rate. So considering that this is a very well-established company, I'm not surprised that it's not experiencing immense growth, and in terms of their cash and debt position, there's nothing that's too alarming to me. But the main advantage and draw to this company is their high dividend yield of 4.25%, and the payout ratio of that dividend is a good metric of the health and sustainability of that payout, and here it's at 57.59%, which is pretty okay. Something I do want to point out is that they did cut their dividend back in the beginning of 2019, and since then the payouts have been very stable, but not growing. Another tool I like to utilize in my research is TipsRank. I'll leave this link down below, but they give you a nice little overview of the stock. The overall consensus is a hold on the stock. The technicals, as we saw, is negative because the price has been going down, but it does potentially create some buying opportunities, and that's probably why the blogger opinion is bullish. But aside from the technicals and the numbers of a stock and their finances, it's very important to actually look at the quality of the brands that the company owns. And when it comes to Kraft Heinz, here are just some of the iconic brands that they own. And I don't know about you, but I recognize almost all of these brands, and I know that these are quality products that the company sells. I also like to look at the breakdown of the revenue whenever possible to see where the income for this company is coming from. So this piece of data is the net sales of Kraft Heinz Company worldwide in 2020 by product category. So by far their bread and butter is condiments and sauces, as well as cheese and dairy products. And when I look at the categories that this company competes in, I'm not nervous at all for the future of this company. These are very stable market demands that I do not see evaporating anytime soon. Alright, moving on. The next name on this list is Store Capital Corporation. So this company stands 4th on the list of best dividend stocks to buy according to Warren Buffett. It's an American real estate investment trust that is engaged in the management and acquisition of single-tenant real estate properties. Berkshire Hathaway holds over 24.4 million shares in Store Capital Corporation, valued at $842.5 million. And the company represents 0.28% of the hedge fund's 13F portfolio. Now, if you've never heard of this company, they're very similar to Realty Income Corp. They're a REIT and they focus in a very similar market niche. And much like with most REITs on the market, in March of 2020, they went through a pretty severe correction, but since then they've recovered nicely, and they're still trading at a discount versus pre-pandemic levels. But taking a look at the finances of this company, they have very strong revenue growth, and this is one of my favorite things about this company. So in December of 2016, they had $376 million in revenue, and December of 2020, $697 million. So their financials are rock solid, and they pay a hefty dividend of 4.5% with roughly a 6% growth rate in that dividend. The consensus is a moderate buy, and overall they give it a neutral rating. But just like with the previous company, it's very important to understand what your investments actually do. So let's read just a little bit of this article to get a better understanding of how this company makes its money. So this REIT specializes in single-tenant net lease real estate, mostly in the services and retail industries. At the end of the third quarter 2020, Store Capital owned 2,587 properties throughout the United States, leased to 511 different tenants. The company looks for specific types of properties to acquire, specifically middle market properties occupied by single tenants. They prefer service-based properties, which account for 63% of the company's rental income. The key takeaway is that Store Capital's properties are not easily disrupted by e-commerce and not especially prone to recessions. So that's the core strategy of the business model of Store Capital. But the next name on this list is Verizon Communications, ticker VZ. So this company needs no introduction. It's an American multinational telecommunications company that provides information and entertainment products and services to its customers around the world. And yeah, there's not much to say about Verizon besides that it's very boring and stable business, which depending on what you want in an investment could be the exact right match for you. Over the past 5 years, it's only appreciated 10%, and in the past 12 months, it's actually down 14%, leaving it a very attractive PE ratio of less than 10. There's also the inverse relationship between dividend yield and stock price. So as the stock price has been going down, the yield in the past couple months has been going up, and now it sits at close to 5% at 4.81%. And here's a revenue breakdown of Verizon, and the vast majority of their revenue comes from providing cell service. And we can see right here that the year-over-year revenue growth is 4.35%. So this is not a growth company by any means, but the revenue is impressive and it's very stable. And if you combine that with its very cheap valuation right now, that's why most people give it a moderate buy and a pretty good rating. So the average analyst price target for Verizon is $59.43 per share, representing a 13.92% upside potential for this stock. So if you're looking for stability and high yield, Verizon is always a pretty reliable choice. Now moving on to number 2 on this list, we have AbbVie, which is a pharmaceutical company. So Berkshire Hathaway owns 20.5 million shares in AbbVie, valued at $2.3 billion. And that accounts for 0.78% of the hedge fund's 13F portfolio. If you look at the 5-year price action for this company, it's kind of all over the place. It has its ups and downs, but overall it's up 85% in that time frame, and over the past 1 year it's up 18%, but it still has a PE ratio of less than 10. AbbVie does have very impressive overall revenue growth, especially in 2020. Their revenue grew by 37.69%. And when it comes to their products driving this revenue, here are their 3 main offerings. And in terms of their overall rating, they have a 6 out of 10 with a strong buy consensus. And the price target right now is around $130, which is an 11.67% upside potential. And that's based off of 9 Wall Street analysts offering 12-month price targets for AbbVie. And that leaves us with the number 1 name on this list, and that's Chevron Corporation, ticker CVX. So Chevron tops our list of the best dividend stocks to buy according to Warren Buffett. It is an American multinational energy company, and it's the 2nd largest oil company in the US. Berkshire Hathaway owns over 23 million shares in Chevron Corporation, valued at $2.42 billion. Now, when it comes to oil companies, most people, including myself, are bearish on their long-term outlook. But that doesn't mean that in the short term, they're not great potential investments. And I believe that that is the situation that Chevron finds itself in, because in 2020, the demand for oil globally took a big nosedive. And since then, the price of Chevron has been appreciating quite aggressively. In the past 12 months, it's up 40%. and the PE ratio is still only 13.8. Taking a look at their total revenue, in 2020, of course, it took a massive nosedive, but since then, there has been an immense recovery. And the year-over-year revenue growth is actually 82.68%. And that's why, even according to this data, they have a 7 out of 10 and a strong buy consensus, with a general price target of 129, which represents roughly a 10% upside potential. But that's going to do it for this list. Those are the top 5 dividend stocks according to Warren Buffett. I have to say, personally, my favorite one on this list is number 4, which is Store Capital. I just think overall this company has a very strong strategy, and I like the business model that REITs offer. And aside from that, their financials look very strong and healthy, they have a very high dividend, and their valuation isn't insane right now. But let me know what you guys think in the comments down below. If you're still watching and enjoyed, definitely give the video a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.